If the green product is not accessible, affordable, it's not gonna work. I mean, at the end of the day, businesses remain businesses. And even if I really believe that we need to change things and to adapt the business and to make things differently, the truth is, without regulation or specific incentives, things are not going to change.
That's Eric Gossart, a partner at Serena Venture, a French VC firm based in Paris that raised close to 1 billion since they launched. Today, Eric leads Racine2, or Square Roots in English, an 85 million euro fund focused on climate, health, and education. In today's episode, we will explore the climate investing landscape as it compares to traditional VC.
Even if it's an impact company, we have to assess the company as a normal company. So we keep looking at the business model, the market, the team, and so on.
Eric will walk us through how he created a new type of impact fund.
We started to work with Make Sense, which is a non-profit organization, and decided to do a partnership to raise this fund, bridging both the VC expertise and the impact expertise.
What he's learning now as an impact investor.
What did I put in place in terms of deforestation? Am I sure that my supply chain is sustainable? This is the kind of question we have to address when assessing an impact company.
And some hot takes.
Moreau, the founder of Phoenix, used to say that when he started to do some marketing, he has been criticized by the impact startups as you are an impact startup, so you can't do some marketing, which is nonsense.
Thank you to everyone listening to this episode. And don't forget to like, comment, and subscribe to the YouTube channel. Or if you're listening on Apple Podcasts or Spotify, don't forget to follow and give us a 5-star review. Enjoy this episode. I think to get started, we need to learn a bit more about you. I'd be curious, how did you get into venture capital in the first place? Because as you said, you're now focusing on climate, but before you were more like a standard traditional VC. How did you get there? Why venture capital?
I think that has been a long journey. My mother was a ballet dancer and my father was a opera singer. So I mean, very far from the entrepreneurial journey or the venture capital journey. But I've always been inspired by entrepreneurs and looking at TV shows in France. And once I entered the ESCP, so the business school, I discovered the startup industry. So I started to do some internship within startups, and this is how I ended up discovering startups need capital. So I joined this startup, then several venture capital funds such as Caporn Invest and an LBO firm called Galena. And so I really liked this industry, how to back entrepreneurs, how to have a very holistic view on different industries. And I joined Serena back in 2015, so that's been 10 years now. So I think that's pretty unusual when you look at the traditional career, doing the same job for 10 years. It sounds like more your parent job, working in the same career. But I had the chance to enter within a very ambitious company. And I believe that when you do this kind of work, you need consistency and trust. And this is what I found within Serena. And today, so I'm managing Racine2. I have the full ownership, and I managed to align both my personal aspiration and my professional career.
Yeah, and I love that because you said, I've been doing the same job for 10 years, but you haven't really, because you've transitioned from Serena, which was this big VC investing in technology, to Racine2, which is very different. Why did you want it to go? Build a VC firm to invest in ed tech and climate tech and all of the other impact space where you invest.
Yeah, I think that's a matter of alignment. I need to align my personal aspiration, expectation, and my professional career. And when I was working at the traditional VC fund, investing in tech companies, that was very rich because I learned a lot. I had a very steep learning curve. because early in my career, I had the chance to do my first deal, to sit at the board of many companies. So that was, I mean, in terms of learning curve, that was really, really interesting. But I felt that I was a bit disaligned with the kind of, I mean, there was a lack of meaning, the lack of sense in what I was doing. So I needed to just make sure that what I do has a sense for the future. And this is what I find within the impact fund. Um, just for instance, when I was working with the traditional VC fund, I was like a bit questioning the industry and the sense of the industry because of the pressure it puts on companies. When you take, for instance, the cab companies such as Uber, in reality, we are just like erasing a monopoly to replace it by a new monopoly. We erased G7, G7 in France, just to replace by a new monopoly, which is Uber. So I think we are uh, just like changing the capital, the shareholding structure. But at the end of the day, that's always the same happy few who are winning.
So, am I correct in understanding that basically for you, venture capital is not only about money? That's the reasoning that you have, and that's the reason why you wanted to move away from traditional VC into impact VC.
Yeah, exactly. I think that we have the chance to be able to highlight some companies, to highlight a kind of future. So that would be a mistake to not try to shape a future where we feel aligned. And so yes, it's obviously about finance and money because we have to have performance to make sure that our business model is working. But at the end of the day, you have to make sure that you put the money at the right place. So am I the right one to decide which is a good place and which is not? Maybe not, but I have the chance to maybe shape a future that I think that I believe is more responsible. So why not doing it?
Agree with you, and I think we were discussing earlier. I'm obviously, as I said, an aspiring climate tech VC, and I think that's for the same reason because I believe there's more to do than just helping company grow, but there's also like how do you make sure that you build a future that you like and that your children and grandchildren will also enjoy living in, because obviously on the current trajectory we will be very far from something enjoyable within the next 50 years. Today's episode is really about what you've learned in traditional VC versus what you're currently doing as an impact VC. And I think maybe to get started on that, we need to define what impact means to you. I know it's very difficult.
Yeah.
I can start and give my own definition.
Yes,
for
please.
for me, impact is really about, and I look at it from the climate lens. That's really the part that interests me the most and the part that I'm more worried about it. But for me, impact is anything in a company that doesn't have to do with the revenue or money, but that's beyond that and create a positive impact on its ecosystem. And for me, ecosystem means like the natural ecosystem, climate, biodiversity, CO2 reduction, and all of that. So that's my definition of impact. It's how a company affects its environment positively, beyond money. What's your definition of impact?
Actually, I like this one, but I will add that I will link that to the revenue because I think that we have to align the revenue, the business model, with the impact of on the stakeholders. So I will take your definition and will add this need to align the business model, the revenue, on the way we impact the ecosystem, and this means all the stakeholders, including the employees, the shareholders, the suppliers, the customers, and so on.
That makes a lot of sense. And taking that into account, taking this definition of impact into account, how have you seen your investment approach or like investment criteria evolve as you became an impact VC? What are the things that you were not looking for in previous companies and now are central to your investment thesis?
Yeah, I think that taking care about the customers, the people we can affect with the solution. So this is something I didn't take into account before. And once I joined Racine2, I started to be more conscious about the final customer, to make sure that the solution is bringing something new to the customer. So, and at the very beginning, I was like very. I wanted to completely change the way I assess companies because I believe it was something very new. So I wanted to look at the social impact, environmental impact, and I was very strict about that. And I think that even if it's an impact company, we have to assess the company as a normal company. So we keep looking at the business model, the market, the team, and so on. So, but the way the solution impacts the end customer and the way the funding team is aligned with the mission is something new.
That makes sense. And what I like about this is impact companies must make money, because a company that dies within a year doesn't have any impact, basically, right? So I think that's something maybe people sometimes forget, and they think sometimes about, impact company or climate tech company are like philanthropy investment. And they're not. Like, they're companies trying to change the world, and they're evolving in huge market, usually like markets where like there's a ton of money to make, where you can replace the old fashion and old way of doing things. And eventually that will, return a lot of money to VCs as well. But you mentioned something about the team. The team is something you look after. And I think, the old ways of looking at it was that you need a hacker, a hustler, and a hipster. That's the last one. When I was looking at climate tech companies, usually I find a PhD researcher or someone that comes from the lab, basically, let's call it from the lab, and then maybe more of like a hustler, like a sales guy, commercial guy. What do you see in those impact companies? Like, what is a good team in impact in general?
I think that's a definition which evolves with time and industries, but I believe that it really depends on the stage of the company, because at the very early days of deep tech companies, obviously you need PhD researcher and so on. So sales guys wouldn't be useful in this kind of company at the very beginning. But you have to make sure that the researcher is able to have a personal learning curve on the business side. So you have to make sure that this guy is able to understand the business model mechanism, the go-to-market strategy, and so on. But at the very beginning, if you do not have a researcher, you are not going to ship a product, so you don't need a sales guy.
Is it hard to change a scientist into a seller?
It depends. I have one example I've been told by Olivier Vory, who is a business angel. He has invested in Akemia, which is a deep tech company in the drug discovery market, and he had the chance to find a very a true researcher who he told me that this guy, I don't remember the name, was not able to do a cold email on LinkedIn. So, but he took some time with him to coach him. And at the end of the day, Akemia just raised, I think, 100 million round. So I think I think it takes time. But at the end of the day, if you find someone who is able to have like a personal growth, personal learning curve, you will manage to get the right team on board.
That makes sense. And we can obviously say that someone that raised 100 million for its companies is a good seller, because like it takes a lot of effort and a lot of pitches and a lot of sales to get there. So I agree with you. I think it's a beautiful example of someone that was a scientist and became more of a seller, or at least had somehow a way to sell its company to other people.
Yeah, and you can assess that when talking to people. Is the person a good listener? This is the first thing you can assess with someone. Is he listening to you? I don't care if at the end of the day he applies my advice, because my advice is pretty, I think most of the time I'm wrong. So, but I don't care if he doesn't take into account my advice. But did he listen to my advice? And this is like something you can assess when talking to people.
Yeah, that makes sense, because you need someone that listens to you and someone that is willing to go outside of his comfort zone and try new things and do things differently. But I have a question on that. Like, why every time I meet a VC, they always say that their advice are useless or that they're wrong? Why is that?
I think that there is part of humility, and then there is part of it's very hard to really explain the value add we have. So there is not a specific framework, and that would be a lie to say that there is playbook where companies can success. So I think that just a matter of how people are able to connect between each other and how they are able to understand each other. So each relationship is unique, and it's just a matter of ability to brainstorm with the founder, and it's very hard to specifically explain and frame what we do and how we add value. So I think that's a way of avoiding the question.
Yeah, I see. I think I'd love to talk to some of your portfolio company and see what they say about you and how you add value, because I'm sure you add a lot of value to their company by how you work with them and partner with them. But I agree with you. It's difficult because I think it's difficult from one side because you're not part of the company in the day to day, and I think it's hard to understand really what's happening. I mean, you can understand it to an extent, but you don't live it, and so therefore it's different for you. But I think on the other side, I agree with you that it's hard because VC add value in a way that's not always tangible. If you do, for example, an introduction to a potential customer, you might forget in a year or so, and then you kind of forget the value you added there, but maybe you've unlocked big sale and a big customer for that company, right?
Yeah, but I think if I try to just maybe elaborate on that, I think that's one of the value of the VC is just bringing trust to the founder. So do I trust the founder? Do I trust the choice of the team? So this is, I think, one of the very key elements to make the founder stressless. Then the ability to bring money without any complex process. So sometimes investors say, okay, I'm going to bridge the company, but I have to ask to my investment committee. It's going to be in 2 weeks from now. And then once 2 weeks after you get a feedback from the VC, okay, I'm just gonna wait because we have this topic. I would like to assess maybe a bit more the business plan and just digging the customer and so on and so on. And sometimes just refinancing the company could take 2 months or 3 months, and at that moment the funders need reactivity. So I think that's a key element. And if you manage to bring that to the funders, trust and reactivity, if that's the right word in English, trust and reactivity, I think that's a lot of value. And then you have the customer, the brainstorm, the strategy, and so on. But trust and reactivity.
Yeah, and I think, I don't know if it's the right word in English, but I'll define it. But what you mean by reactivity is being able to act fast whenever something happens, being able to react fast to something that happens. And then it's interesting because then you came back to the original value of what a VC is, which is basically financing company. That's their role. And you see the value of VC as being able to do that without putting funders in struggle or creating struggle in the company. You mentioned trust earlier. I think something that's interesting, I was discussing that on another podcast earlier this week, is I feel like VC also act as signals to the market. Because, for example, if you take a climate tech company, let's take carbon removal, because I think that's something that's quite new and, an emerging market. I think the more VC we see investing in carbon removal, but we can do it about any other technology, the more it signals to the market and, future investors and potential buyers and partners that there might be something happening within that ecosystem, right? Is that the way you see it as well, as an enabler for future opportunities?
Yeah, sure. I mean, the VC is working on signals. So depending on what kind of VCs you've got, is it a tier one VC or tier two or tier three? You are going to have like a different equity story. You know that if you raise with Serena, for instance, just like in France, you have more chance to maybe to be contacted by a US VC firm a few months later. So yeah, obviously this is a market of follower. So people are following peers. So you have to have the right signals on board. And yeah, I think that even for the suppliers, the customers, that it is always reassuring to see that you've got like financing from tier one VCs. So sure, I think that in that sense, VC is an enabler, but we have to remind that it's a very, very small asset class, and the first signals in France actually comes from the state, from the government, when we decide to, with France 2030, to back very deep tech companies. It is a big signals, much more than Serena investing in a small company.
Yeah, that's interesting. That I love the fact that you say, and you're obviously right. Like if Serena invests in a company in France, it has a huge impact. But I love how you think about that as an enabler for like American companies or American VC firm to invest in those companies. But I love to go back to the assessment of the company. So we already mentioned the team. You already had a great answer on the team, which is like usually a PhD researcher plus someone that's going to be more of a seller, but maybe later on, because we first need to have an MVP. That's kind of my understanding of it. I think something else that really is special to Impact is how do you have a business model truly linked to impact? And by that, I mean that you cannot grow revenue if you don't grow your impact, right? Is that something important when you look at a company, at an impact company? Like, do you want to see that there's going to be a one-to-one correlation between $1 of revenue and, let's say, 1 ton of CO2 reduced, or whatever the impact is of that company?
Yeah, in the perfect world, it's very linked. But one way to address that is to make sure that, for instance, for a B2C company, you have to make sure that the product offering is accessible, affordable to people. And this is a way to increase revenue and increase your impact. But if you take like other examples, such as Tesla, for instance, you could say, okay, the more cars I sell, the more impact I have. But it really depends. If I sell cars in China, the impact is not that good, because like the Chinese energy is has a huge impact on the carbon emissions. So and the more car you sell, the more deforestation you get, because you have to access to specific materials. So is my revenue really linked to the impact? In that case, naturally. So you have to find new KPIs to address these topics, such as, okay, for one car sold, what did I put in place in terms of deforestation? Am I sure that my supply chain is sustainable? This is the kind of question we have to address when assessing an impact company.
Yeah. And so that brings another topic, which is like, I think they call it negative externality, which is what is the impact of your products on other ecosystems. So basically, let's say, for example, we're talking about carbon removal, because I think it's a good example. If you're able to remove carbon out of the atmosphere, obviously that's a good thing. But then what is the things that you're doing on the side of that, or what are the processes that you put into place to do that? If you're going to do that by using energy from coal or like from wood, for example, that produces a lot of CO2. The question remains then, like, have you removed carbon from the atmosphere, or have you produced more because of your processes? How do you take that into account in your investment process when you look at companies? Like, what are the other factors, like other ecosystems that they influence throughout their supply chain and production processes?
Actually, we are not doing that at the moment, but I have one example with Planet A that I know that they have like a life cycle analyst within their team, which is very specific to address this thematic. So I think this is a good way to address this topic. But actually, at the moment, we do not have things specific things on that topic.
For sure. And interestingly enough, Benedict, who is the life cycle analyst, is going to come next on the podcast to talk about this very specific topic. So that's going to be very interesting. I'm excited for that. So we have another topic that you mentioned already about the price, about making sure the product is affordable. I think something that's interesting is I see more and more VCs saying, I don't want the business model to rely on a green premium, meaning the ability of people to pay more for the same service just because it's more sustainable. Is that something you're against? Is that something that you look at and you're like, I don't know that it's going to work?
Yeah, I agree with that. I think that if the green product is not accessible, affordable, it's not gonna work. I mean, at the end of the day, businesses remain businesses, and even if I really believe that we need to change things and to adapt the business and to make things differently. The truth is, without regulation or specific incentives, things are not going to change. So if you go on the market with a with a product which is more expensive, I think it's not gonna work.
Yeah, for sure. I think only a few people have the ability to pay more for the same products because of either financial constraint or just because of their willingness to do so.
Yeah, and companies are looking at their margin and so on. So I would love that businesses naturally change and adapt their business, but that's not gonna work this way, unfortunately.
Maybe in the future, something that
Maybe.
we bring up to the table is like the topic of measurability, and I hope that every company in the world, even public companies in the future, are also measured against their impact, not only on their financial performance, but let's see if we get there one day. But that going back to the topic of startups, is it important, measurability, for you? Like, is it important that they're able to measure the impact they have on their ecosystem? Is it important for you that they report on this impact, as a venture capital? Like, is that something that you care about?
Yeah, sure, because you cannot change something you don't measure. So you have to implement KPIs and measure your impact. At the very early stage, it's very complex because the company has no business model, no markets, so that's very hard to implement KPIs. But this is something we do within Serena. So we set a sample of 3 to 5 KPIs to measure the impact on carbon emission, for the affordability of the solution, and so on. So this is something we put in place very early in the company life, so that it is very easy for the company to measure their impact as just like they measure their financial KPIs and so on.
And what's the reaction of funders when you tell them, hey, like, we're gonna, have these KPIs for you and you need to implement them?
They are very, very aligned because this is something they truly care about. This is something we assess when investing in a company. We try to really understand to what extent the founding team is aligned with the mission and the vision. So usually when we mention the KPIs, they are like fully agree with that, and they know that we have our carried interest, which is indexed on this KPI. So this is a way to align both the investor and the company. So they are pretty happy with that because they truly care about that.
On that topic of the carried interests, can you explain it to me? I mean, obviously I know what it is, but I think it's important for people in the audience, specifically funders that are not, expert of venture capital, to understand how an impact carried interest looks like what it looks like and why it's important. Because I think that's something that's quite new. I think it's became something that impact firm have been doing for maybe the last 5 years maximum. And it really, for me, has a huge impact because, as you said, it aligns everyone on the same outcome, meaning the outcome there is to have an impact. So can you explain a bit more how that works?
Yeah, sure. I mean, just for the audience, the carried interest is a way to align the investing team with the company and the performance. So for each time there is proceed within the fund, 20% of the proceed is distributed among the team. So for the impact carried interest, we just align the performance with the impact KPI I mentioned. So if I manage to reach my impact goals, so so for instance, reducing the emission by 50%, if I manage to do that, then 100% of the carried will be distributed among the team. If I don't manage to achieve this KPI, I'm gonna just distribute 60% of the carried, for instance.
Yeah, that's interesting because that really forces VC to invest in companies where they know the impact is going to be achieved. Like otherwise, you will not get your money. And I mean, as much as I believe impact VCs care more about having an impact than money, obviously it's an incentive that they should look after. So I think it's really a great thing.
Yeah, exactly. And I'm sorry to interrupt, but I've been questioned about that recently because I've been told that if I were a truly impact investor, I would not get carried. But I don't really believe in that because there is no sense that when you try to do good, you are not incentivized for that. So this is something I think that's important to be an industry as attractive as the others.
For sure, because you need to have the best talent, the best people, and as we said earlier, climate and impact is not philanthropy. It's really it's a way for people to make money as well. And I would push it a bit even further. I would hope that in 20 years from now, the most valuable companies in the world are the ones that have the most positive impact on the ecosystem, that are the most sustainable, that are the most welcoming from a social aspect and great for people working for them and for the customers and for the suppliers. Like, I would hope that the best companies and the most valued companies, so from a money perspective, are the ones that have the most impact in the future.
Yeah, exactly. And you do what you want with your money. If you want to distribute your money and give back to foundations or to non-profit organization, do it. But yeah.
No, for sure. Indeed. I completely agree with you on this one. Going back to how to assess a company, something that I've been struggling with a lot and reflecting a lot on is if you invest, or at least like within deep tech and even within like a lot of the climate tech and impact companies, it is often quite scientific and hard to understand. Like it's hard to understand what they do. It's hard to understand the product. It's hard to identify whether or not it's going to work, especially when you invest early stage. Because obviously a lot of VCs are not scientists. They're often more like business people. So I'm curious about how you deal with that because I think that's something that, you know, in the past within the software world of venture capital was quite okay to understand. Obviously, you don't have the entire technical background, but you kind of understand what's happening with the software. I think with this more scientific investment, it's a bit harder to understand if the product's going to work or not. So I'd be curious about how you look at that on your side. Like, how do you deal with not exactly knowing what the product is about sometimes?
I think it's a matter of risk diversification, as we invest in a lot of companies where we manage to mitigate the risk, and then we tried obviously to do a lot of due diligence, working with some experts to get some feedbacks, and then for the hardware companies or biotech companies and so on, we are just looking at a specific TRL. So, for instance, we are not looking at TRL 1 and 2, but starting at 5. So this is a way to mitigate the risk as well.
Yeah, and I'll put the link to a TRL in the description. TRL means technology readiness level. Basically, 1 is like your product is, you've just observed what's happening and you don't really have a product yet. And then 9, I think, is like the product is fully deployed in the market, it's fully working. Like we know that the science behind that is working. So I'll put a link down to like a map of what a technology readiness level looks like, just to help people understand where you invest. But 4 and 5 is you start to have a sense of, okay, that's going to work. Like the science risk is not so much there anymore.
Exactly, and I wouldn't be surprised to see more and more researcher turning VCs. So I think that at Partech, Boris Golden was a previous PhD or researcher in a specific thematic, and he turned VC, so in the tech side VCs. But I wouldn't be surprised to see more and more different profiles entering the industry.
Yeah, I think it's great to see more diversity within the VC ecosystem. Something also that I think is important to understand is, how do you do due diligence on an impact startup? Because you were mentioning already that you're doing a lot of due diligence, because also it's sometimes harder to understand the product. But like, how do you do it? Like, do you call scientists that you know? Do you call partners in big companies that might buy their product later? Like, who are you talking to do a due diligence on an impact company?
Yeah, we have the chance to be working with different experts, researchers, some engineering schools. So we managed to get feedback from the industries, and then we do direct cold email to researcher on LinkedIn, for instance. And usually they answer, and we can do like free due diligence. Yeah.
So VCs also send cold emails.
Yeah, exactly.
It's not only for funders, right?
No, we do a lot actually for the industries, like big corporate and so on. We reach to M&A as well, to strategic partners. So yeah, we do a lot.
That's great. And just to close this chapter on climate investing, and I think after that we will talk about how did you build a climate fund and how do you look at like an impact fund versus like a standard fund. But just to close this chapter, how do you deal with a more capital intensive sector? Because usually those more scientific projects, they require a lot of capital up front to even do an MVP. Cost a lot of money, while like a software MVP is probably within the $50,000 you can do something. For like some of the scientific project, it takes some time, a couple of $100,000 if not millions, to just build something that might work maybe. How do you deal with that?
Again, we don't really invest at the very, very early stage of the company, but still there is a lot of capex. But the way of dealing with that is to take a big ownership at the very beginning, because we know that the equity story and the fundraising story is gonna be very different from a traditional software company. For instance, I know that for the infrastructure deals, for instance, we usually the average dilution is like 35%, whereas when you look at software company, it's gonna be between 10 and 20%. So the first thing is to make sure you have a good ownership at the very beginning, because like the cost of the fundraising is gonna be high.
So that means when you say different equity stories, that means that basically, if we just do a small recap, if a company raises a seed round, let's say you come in and you own 30% of the company, but because it's a more capital intensive area, they will raise more money along the way. They will probably raise money longer because it will take them longer to get a product out to market and to reach profitability. So therefore, that means that you as an investor will get more diluted than in software. Is that the way I understand it?
Exactly.
Great. That's interesting, because it means also that I wonder who's investing later then, because like obviously at some point like you raise like massive amount of money. I mean, obviously, like for example, Northvolt was one of them, where like I don't know how many. I think they raised like a couple of. Is it 15 billions or something like that?
Yeah, probably.
So I wonder like who's paying for it? Like VC are not paying for that, right?
No, you have government, infrastructure funds as well. But yeah, that's a real point, because like for the hardware companies and the climate tech companies, at the very beginning, sometimes you manage to get to access to VC's financing, but then you have like a sort of a gap between the VC and the infrastructure funds, because the infrastructure funds are looking for like developed project for specific IRR, and they are not able to take technological risk. And the Series B, Series C VCs are not comfortable with the industry and the infrastructure. So that's very hard for this kind of company to bridge the gap between the VC financing and the infrastructure financing.
Yeah, because obviously, as you said, like the infrastructure fund, or at least in my opinion, they often look like for profitable companies already. They just come in much later. But I mean, I don't think that's a topic for Serena anyway, because you guys, I mean, at least Fast and Carré has like 2 years, like he's 2 years old or something. So you probably don't have companies that have reached Series C or something by now.
Not yet, but we hope so. But yeah, but as I've been investing as well on the other funds at Serena, I have the experience of Accenta, for instance, so which is a geothermal companies. And so yeah, I've been investing in. I have invested in the company at the seed stage, and today we are at the Series B stage, 4 years later, and yeah, we had to deal with this gap.
That's interesting. And I'm curious, well, first of all, how did you deal with the gap?
We had the chance to co-invest with an industrial partner at the very beginning. So this was a way to back the company with someone with an industry expert able to understand where the company stands and to be able to back the company. So I think that this is something very specific to the climate tech startups. So sometimes how to deal with industries and industrial partners.
Yeah, because for sure. So because the industrial partners usually have more knowledge and also more money, because they are often already investing, for example, for their own factory, investing already like billions in capex or like millions in capex. So they are a bit more used to like the size of the investment that's required and a bit more comfortable with what it means from, like a P&L perspective later on.
Yeah, they are on the field and they understand the business. So yeah.
How did you invest in Accenta when you were at Serena? Because I feel like when you were talking about it, it was like you already had in mind the impact fund for later. Like you already kind of knew you wanted to go there. Like is that correct?
Partly because I really wanted to try to invest in company with a lot of meaning for the future, and so I did not know that I would raise the impact fund later, but actually, at the very beginning, Accenta was a pure software company. So they were bringing on the market a software, an AI software, to help companies to help buildings to reduce their emissions, and that's on the fly that they discovered that it was interesting to implement geothermal energy to drastically reduce the emissions. So this is how we started investing in a software, a pure software company, and ended up with a industrial company.
Were you happy with the transition?
Yeah, sure. I mean, like we have like a very nice equity story, and I mean it makes a lot of sense in terms of impact as well.
Yeah, because it's probably hard to deal with like the change from like a very low capex business, which is like software, to a very high capex business, which is more like industrial. Like as an investor, it must be a bit scary when they tell you like, hey, by the way, we will pivot to something a bit more industrial.
And this is where I go back to what you look at, to the value add of a VC is to bring trust on the table. So this is what I try to do. But the very difficult part is to explain that to investment committee. So, hey guys, we have like a pure software company, and we are starting to deploy very like high capex model. So that was very hard.
Yeah, I trust you on this one. So as you said just like 2 minutes ago, you've raised an impact fund, and I think now we will talk a bit more about like the VC dynamic from traditional versus more standard VC. I know the story is a bit unique in how you raised the fund, so I'll let you explain it. But like, how did you manage to do that? Because I think if you're part of Serena, which is very standard, like you have to be a leader in the sense that you have to say, hey, like, I think there is a good opportunity to go there. I think the financial makes sense, but then the impact makes sense as well. Like, how do you deal with that internally, and how did you raise the fund as well?
Actually, I have the chance of working with a team which is very aligned with the mission and the impact. So that was not hard to convince, but the part which was hard was to set up the right framework to raise the fund, as we were not legit to raise an impact fund because we are coming from the software industry. So that's why we started to work with Make Sense, which is a non-profit organization, and we started to work with them and decided to do a partnership to raise this fund. So this was like a way of pioneering the industry, bridging both the VC expertise and the impact expertise.
And is that also why you've built a new brand? Because Racine Carré, if you just look Racine Carré on the website, you don't really see that it's part of Serena. I mean, obviously it's probably written somewhere, but like it's almost its standalone fund. But whereas, for example, if you look on your LinkedIn profile, you're still working for Serena, right? So like, is there a reason why you decided to build a specific brand? Is that to be more legit and to say, hey guys, like actually we're going for it. We're not Serena anymore. We are Racine Carré. We're investing in impact.
Actually, it's more for internal process because we co-manage the fund between Serena and Make Sense. That was easier to have a new brand instead of saying okay, it's Serena and Make Sense. And then we have a unique LP called MGON. So that was also a way for MGON to do some communication and marketing around this brand.
And who is MJN? Because I don't really know them. Like, because I was about to ask, like, do you have a different discussion with LPs when you raise like an impact fund versus like a standard fund? But let's talk about your LPs then.
Yeah, exactly. Actually, Racine Carré, like the origin of Racine Carré is a tender offer from a mutual or insurer called MGN, which is so the one of the main insurer for the teachers, and so they wanted to have like a specific fund dedicated to impact, including the climate, the health tech, and the education. So that's how we ended up managing this fund, and we answered to the tender offer alongside Make Sense, and yeah, so that is a true chance when you manage to align the interest between the LP expectation, the GP commitment, and the founders. So that was like the perfect setup to start in the impact industry.
Yeah, it's great to have them with you along the journey and knowing what you invest in. Did they drive the investment thesis? Because you said they had area where they wanted to invest, which happen to be exactly the area in which you invest yourself, right? So I'm curious, like, is that a dynamic? Like when you talk to an LP, like, do they drive a bit like the investment thesis, or like, are you the sole owner of like the investment thesis?
Most of the time, actually, LPs are driving the investment thesis. So, and not all LPs, but on the French market, let's say that the French investment bank, so the BPI, is driving the investment thesis, as they have like a mandate to invest in specific areas to make sure that we have entrepreneur journeys in a specific industry. So yeah, they are saying, okay, that would be great to have like a fund dedicated to the biodiversity, or that would be great if we could foster the investment in the industrial sector. So they have like a mandate to fund these funds, and so that's how GPs are adapting their investment thesis. So at the moment, it's the applied AI and the climate tech sectors, and maybe in 2 years from now, it's gonna be another industry. So that's I would say the main job of the BPI. So yeah, LPs are driving the investment thesis.
And what happens if you invest in something that's, like, is it written in the contract that you must invest in this type of companies? Or like, what happens if tomorrow you decide to invest in something that's a bit outside of the thesis?
You always have like a wide definition within the agreement, so you can like adapt the investment thesis on the go. The only thing is that if you make like an investment outside the investment thesis, if it's a huge success, no one will thank you for that. If like it's a very big mistake, here you'll get a phone call from your investor.
Yeah, for sure. I can imagine. Going back to like traditional VC versus climate tech VC, or like impact VC in that sense, I think we were talking about the equity story. It takes a bit longer. It requires us more money. Does that also affect your investment cycle as a VC? Because I know usually it's within like 7 years is a standard VC firm to deploy capital. Do you expect it to be a bit longer with Racine2?
I think that we have to go back to this statement. So if you look at the statistic and the data from the BPI and the FEI, which is the European Investment Fund, actually like the average duration of a fund is like between 15 and 70 years. So like the statement to say that, okay, it's a 7 to 10 years duration is pretty wrong, actually. So I believe for sure that we have to take into account this. No, I believe that indeed for the climate climate tech industry, it's gonna take time, as you have like high capex. It's a capex intensive model. So yeah, as the software fund is taking like the average duration of a software fund is like between 15 and 70 years. There is no chance that it would be shorter for the climate fund. So we have to rethink about the liquidity strategy, and that's why I think one of the strategy to adopt is to cash out from time to time at the Series B, at the Series C stage, and so on.
And how do you do that without sending a bad signal to the industry? Because I can imagine if your lead investor starts to say, if your lead investor starts to say, I'm going to sell some part of my equity in the company, that might be a bit of a weird signal for the rest of the investors, because they might be like, okay, he knows a lot about the company. He's been there for 5 years already, and he wants to sell.
Yeah, but I mean, my job is not to take the company from the seed to the IPO. I mean, I have to mitigate my risk, and like the growth investors know that. So and they are sometimes happy to clean the cap table and to get maybe some shares with a discounted price. So my job is to make sure that the company raise the Series A and the Series B, and after that's normal to mitigate my risk. So this is something which is pretty usual. Doing that at the Series A stage would be a bad signal. Doing that at the Series C is okay.
Okay, that makes sense. I like that. Are you expecting lower return from that fund? And I know I'm specifically asking you that with an idea in mind that, obviously I hope you don't, but I want to push you into understanding why you don't expect lower return.
It's just a matter of patterns. If we believe that like the environmental crisis, the health crisis, the economical crisis is like the new normal, we cannot just invest in the same industries as we did for the past 15 years. So we have to look for the new macro trends. And I believe that the impact is the new macro trends where we are going to see the next huge success. So I don't have data to back this statement, but this is what I believe.
Yeah, I think I have one data point in mind always. Is like the climate tech industry is supposed to grow from 5 trillion to 12 trillion between 2020 and 2030. It's like within 10 years, more than doubling in size. And we're talking about the entire industry, which obviously means that for VCs and for successful companies, it's much more than that. And it's a great opportunity. one last question, and then we get into fire questions. But one last question, I think, and I'd love to have a very long, detailed answer on this one, which is like, what do you think you've learned from 8 years within a traditional fund that you can now apply to impact? Like, what are the things that you bring along with you in that new world?
I would say maybe the ambition, because when I started to work in the impact industry, I felt that understanding the equity story and the need to make sure that the company is on track to raise a new round in the next 18 to 24 months, this mindset is something pretty new in the industry. Because entering the market, I noticed that we have a lot of legacy players which are very shy with the ambition, and so this is something I think I bring on the table to make sure that we are able to have like ambitious startups in the impact field, and we don't have. This is not something to be ashamed of. To have the ambition of making something big. So this is, I believe, something I bring to the table, and then just like having passed maybe the last two crises, which is going to be the new normal, is something which is valuable for the companies.
Yeah, and I like that you say that some other people were a bit more shy, because I think it's probably like a common thread if you look at maybe investors were a bit more shy, maybe funders were a bit more shy because, like some people are so driven by their impact that they think that money is almost bad, but it's not at all. Like if you have great impact and you're rewarded for it, that's perfect. And I also think that big companies or like historical players, let's say, for example, in the energy market, are also a bit shy to innovate. Like I think they are very comfortable with what they have today, and they're maybe a bit afraid of pushing a bit more innovation and doing things differently because it takes time and effort, and it might disrupt the entire business.
Yeah, I know that Jean Moreau, the founder of Phoenix, which is a French startup, used to say that when he started to do some marketing, he has been criticized by the impact startups as you are an impact startup, so you can't do some marketing. So, which is nonsense. I mean, if we want the company to success, we need to invest in marketing to acquire clients.
Yeah, for sure. Okay, so let's get towards the end of this episode. We have the fire question. So just to explain you quickly the concept, I'll ask questions. You have 1 or 2 sentences to answer. It's very quick. We'll probably cover about 10 questions within the next 5 minutes. You ready?
Yeah, sure.
What's one difference when you assess an impact startup versus a normal startup?
The alignment of the funding team.
Makes sense. I think they call it intentionality, and I love that. I love that word. What's a green flag for you in any of your investment? Like, what's something that makes you want to invest?
The listening skills of the funding team.
What's one red flag then?
When the funding team is not able to make a choice.
Great. Very interesting. I love this one. What's something that you see most impact funders doing very well?
Hiring. They manage to get like a lot of talented people around the table.
And what's one thing that on the opposite they don't do well that you would love them to do better?
Communication. How to be proud of what they are doing and to better communicate on the social network and so on.
What's one challenge that they face? Like, what's one usual challenge that you see in the impact world?
Being perceived as, being seen as a philanthropic company.
Yeah, I agree with that. I think it probably will take years for people to, understand that climate companies or impact companies can drive real great investment and great money. What's one advice for anyone that's, let's say, for example, is a student in science and that wants to start an impact company? What's the advice you would give to that person?
Take an holistic approach, especially on the climate, because climate is not just carbon, it's also nature, biodiversity, social changes, soil pollution. So try to have an holistic approach on this market.
I love that. And what is one advice for a climate VC or like an impact VC?
Keep the good energy.
I love that. I think it's a great idea. I think it's such a tough, I don't know if you can call it a vertical or a market. I don't know. It's very hard to put a word on what impact means, but I think it's such a tough environment to walk into, and it's not always easy. That it's great to keep the energy up. How much weight do you put into technological readiness for impact startups?
Maybe 60%. Yeah.
Interesting. Do you think that we will see more and more sustainability or like impact-driven fund in the future?
Yeah, I'm sure, because like it's. I think this is something which is we are at the very beginning of a huge era, and I believe we also have like a very good landscape in Europe to build a climate and impact fund.
For sure. And do you think that Europe will win over the US on climate and impact?
I'm sure, and because looking back at what happened in the US and the new president, I think that's for once in a while we have like a very huge opportunity in Europe to win on a thematic, and I think that this topic will be climate.
For sure. Do you think all VCs will at some point be impact VCs in some sort and form?
Yeah, I believe so, because if you want to attract and retain talent, you have to adapt the company mindset.
Yeah, for sure. I agree with you. I think that's going to be just part of everything that we do going forward. What's one advice for a general partner trying to raise an impact fund? What would you give as an advice to that person?
Good luck.
I love that. That's the best advice. Good luck to all of them. What's the most impactful climate tech innovation you've seen?
I think that's the geothermal energy, because it's not a huge innovation because it's something which is mastered for a decade. But Axanta did that, and I think it was like a very good idea to adapt something which is already existing to a very modern issue.
For sure, and I think there's tremendous potential for like more geothermal energy, even though it's a very complex topic because you cannot do it everywhere in the world. What's a common myth about impact investing?
Low performance, which is very unfair because looking at the VC performance is not that good. Only 25% of the fund managed to go over 9% of IRR, so that's not like the 20 or 25% expected.
Yeah, for sure. And I think impact VCs might do much better in the future, and I hope so. What's one book or podcast that inspires you in that space?
I think it's a French manifesto from Olivier Hamon. It's called Antidote au culte de la performance, which is how to transform the short-term performance into long-term resilience.
Great, that's very interesting. I'll definitely read this one. Well, we're getting towards the end of this episode. What's your final thought? Is there something that you want to share, as a final thought for this episode?
Thank you for the invite. I think we discussed about a lot of topics, and I think that's definitely a space to look at, and I really believe that we have huge opportunity ahead, and I'm very happy to see that we have like some dedicated podcast on that topic. So thanks a lot.
Thank you so much for your time. Where can we find you online if someone wants to reach out to you?
LinkedIn, Eric Gossart on LinkedIn.
And that's actually correct because I reach out to Eric on LinkedIn, and there we go. We're on the podcast. So if you like this episode and if you like the show, don't forget to like, subscribe, and comment. Eric, who's the next person that should sit in your seat right now? Like, who's the next GP that should come on the podcast?
Romain from Team Pact, or maybe Stéphane from Asterion.
Love that. I'll reach out to the two of them. Thank you so much, Eric. I had a very good time discussing with you, and we'll talk soon.
Thank you.